Howdy, y'all. I'm Raymond Dahlman, and this is the weekly economic update for Monday, September 27th, 2021. Hope everyone had a good weekend. Unfortunately, the Astros sucked. They got their butts swept by Oakland, which was kind of irritating. The Saturday and Sunday games, they lost in the bottom of the ninth by 1 run. So quite irritating for a seam head like me. But I hope everyone had a good weekend. It was pretty nice here. Got some chores done and sat on my ass and watched a lot of baseball and college football. So Cougars won, which is good. They beat Navy, but FSU didn't do so well. And watched a couple other games. What game? I was watching the LSU and watched a little bit of the LSU Mississippi State, and then I flipped over to another game, and then I flipped back, and it was like really close at the end. So, Mississippi State was getting their butts kicked at the beginning. But anyways, like I said, hope everyone had a good restful weekend. We're heading into fall. It's getting a little chillier here. Not today. It's probably maybe 70 degrees outside. A little overcast, but we got some sun peeking out here and there. So. All right, well, let's go ahead and let me share my screen. Nope, not that one. There we go. See that beautiful background right there? I mean, that's where I live, right behind these rocks right here. So this is the road off I-25 that takes you over to the range, and I live back here somewhere. So it doesn't look all snowy like this right now. I have another picture that's all green. So I should probably change it with the seasons. That'd be a good idea. All right. Well, let's start out with the weekly economic update. The week on Wall Street, stock prices were whipsawed last week, dragged initially lower by financial contagion worries and later lifted by supportive Fed policy statement. The Dow Jones gained 0.62. The S&P 500 advanced 0.51. The NASDAQ was flat at plus 0.02. And the MSCI was up by 0.2. A wild week. Last week began with a sharp sell-off on contagion concerns that the financial difficulties of a large debt-laden Chinese property developer could spread to other parts of the global financial system. This added to an existing list of worries that that included Delta variant infections, slowing economic activity, debt ceiling brinkmanship in Washington, and Fed tapering uncertainty. Let me take a drink. Ruji's barbecue, delicious. All right. By midweek, stocks bounced back strongly on news that downgraded the risk coming from China, and a Fed announced that its bond purchases would continue, though it didn't anticipate a moderation in such purchases coming soon. When the dust settled, a week that had appeared set for losses ended in small gains. Coming soon. The Federal Reserve concluded its FOMC meeting last week, announcing that it may start tapering in its monthly bond purchases soon, perhaps as early as November, and could raise rates sometime next year. Fed Chair Jerome Powell provided further details in a subsequent press conference, saying that bond purchases may end entirely by middle of 2022. The support for hiking interest rates also increased, with half of the 18 Fed officials expecting interest rates to be higher by the close of next year, up from just 7 who thought similarly in June. The Fed also cut its GDP growth projection to 5.9 compared to its June estimate of 7%, while raising its inflation forecast from 3 to 3.7. Okay. Economic data coming out this week. Today, durable goods orders. Tomorrow, consumer confidence. Thursday, jobless claims and GDP. And Friday is the ISM Manufacturing Index. That's Institute for Supply Management. We have a couple companies reporting earnings this week. Micron Technologies tomorrow. Wednesday, Cintas Corporation. Thursday, McCormick & Company and CarMax. All right. Well, that's the weekly update. Got 3 white papers that are going out to clients. And those on my newsletter list. The first one is, are your taxes going to change? Wise investors take the big picture view. Well, before I even read this, I can say yes. With the administration that's currently, in Washington, I say it with fairly high confidence that your taxes are going up. And I mean, you don't even have to make a lot. I'd say probably if you're, bringing in 60, 70,000, your taxes are going to start climbing. So now if you have kids and things, you're getting some tax breaks. But for those of us who don't have those tax deductions anymore, it is quite painful. All right, let me dive into this. Most likely you've heard what's brewing in Washington, D.C. called by one of these names, the Build Back Better or the $3.5 trillion budget reconciliation bill or the Jobs and Economic Recovery Plan for Working Families. God, these are mouthfuls. Regardless of what name you've heard, one fact is clear. It's likely to be months before any action is taken. When bills are being worked on, especially one that's this size, it takes a good time to take quick civic refresher. Right now, the bill is in committee with both the House of Representatives and the Senate. The committees are filling in the policy details and the exact financial figures, which can be a long process. Although I do find it, let me stop here. I do find it strange when they want to get something pushed through in a few days, it magically happens. But seeing how they can shove as much pork into these bills takes a long time. They're doing some serious work, figuring out how they're going to rob the populace to continue their welfare programs. Got to keep the post office running. So, all right. It will be up to the House and Senate to vote on an identical version of a final bill if both can agree to a final version. Let's hope not. Right now, it would be hasty to make any portfolio changes based on what's being discussed and debated. An ambitious investor would have to guess at what policies will be in the final bill, estimate the financial impact, and determine what portfolio changes should be made. That's a tall order. So as difficult as it may be, the best approach is to wait and see. We work with professionals who are watching every twist and turn. If something starts to take shape, we'll evaluate the impact. It's a lot of BS garbage at the bottom. I thank my ghostwriter for writing that. All right. Talk a little bit about this. I feel fairly confident that taxes are going to continue to climb until the republic collapses. I'm personally cheering on it happening really, really soon because I'm tired of paying taxes to this federal behemoth. I'd much rather pay taxes to my local state and my county. And even that I don't really like, but at least I see where the money goes. Once it goes to Washington, it goes into the federal government's laundering machine so that they can send it out to their friends and buddies. And I'm sure that the politicians get a kickback from that. I don't have any proof, but you just have to look at what happened with Hunter and his exploits over the last few years when Biden was the VP. It must be nice to be the son of a senator. All right. Next, fallout of a Chinese property market. There's a famous saying about a hurricane starting from a butterfly flapping its wings on the other side of the world. That butterfly effect is certainly happening in terms of Chinese property markets' influence on financial markets around the world. For America, the concern contributed to the worst single day for the S&P 500 since May of this year. Wow, since May. Whew. With building on a decline in China, the effect is felt in related industries in the United States, such as construction equipment and investment firms. This tumult is not the only area of concern in the Chinese economy. Chinese President Xi Jinping is enacting policies throughout the year designed to give the government greater control over private enterprise. That's a bad idea. For many, this is seen as curbing decades of economic growth and genuine game changer for a world economy accustomed to a more permissive Chinese economy. Still, it's important to remember that the regulatory behavior around the world, no matter how strict, is one of the many factors considered by your trusted financial. It's just more blah, blah, blah. So, we've been talking about this for a couple of weeks. I've shared a few articles about the Evergrande, collapse that's going on right now. I saw that they did have a default on some of their bonds. So they're kind of, swinging in the wind right now. So we'll see what happens. Whether or not it's going to be a major contagion that bleeds over into U.S. markets. I think there will be some effect. Continue to watch the, international holdings that I maintain and see whether or not it makes sense to, exit those out of the portfolios. So, all right. Fed rescue September. Bond purchases may end entirely by the middle of 2022. We talked about this a little bit in the economic update. A funny thing happened in investment markets the other day. September was living up to its reputation as a volatile month, but then the Federal Reserve came to the rescue. Fed concluded its FOMC committee meeting on Wednesday, September 22nd. It announced that it might start tapering its monthly bond purchases soon, perhaps as early as November, and could raise interest rates sometime next year. Before the Fed news, the S&P 500 index was down nearly 4% for the month. Fed Chair Jerome Powell said that bond purchases may end entirely by the middle of 22. We just talked about this. So, it's at least in my view, the Fed has kind of painted themselves into a corner. They've kept interest rates, at or near zero for since like 2009. And yes, they were climbing during Trump's administration, but when the market started to wobble a little bit, it appeared that he put pressure on Chairman Powell to keep ease rates and to keep the economy booming. I assume his thought was that keep the economy hot through the election. Just didn't count on Fauci releasing the Fauci flu and screwed up everything. So, is what it is. I mean, I don't like Trump or Biden on a personal level. I personally just think that, Trump would have been better. But in the end, I think this is the best solution. This is going to crash the government, crash the economy, and we get to start over. So, all right, let's see what I got here. I have an article from First Trust. This comes from Brian Westbury. I'll try to breeze through this pretty quick. This article centers around, the employment situation. It's called Less Government, More Employment. It begins, usually the most important economic data report every month is the employment report. And usually that key report comes out the first Friday of every month. But this month is throwing one of those periodic knuckleballs. And so we need to wait an extra week until Friday, October 8th. Nothing strange is really going on. There's no reason for conspiracy thinking, but the payroll report and the employment survey, which give us the non-farm payrolls and employment rate data, respectively, are based on the weeks of the month that include the 12th. Well, September 12th was a Sunday this year, which means that key week, September 12th through 18th, fell relatively late in the month. Some months, the key week is relatively early, starting on the 6th and running through the 12th. In turn, a relatively late survey week mixed with the first Friday of the month being October 1st means there's too little time to put together the report. Excuse me. Right now, the consensus among economists is that the non-farm payrolls grew 530,000 in September, while the employment rate dropped to 5% from 5.2. We will come out with our own forecasts at the end of the week, and then might adjust it based on incoming data on jobless claims and the ADP jobs report. So for all we know, the consensus might be exactly right. After all, payrolls are up 503,000 per month. In the past year, and up 586,000 per month so far in 2021. So what the consensus is forecasting is more of the same. But what the consensus seems to be overlooking is that the national system of overly generous unemployment benefits that has been in effect since COVID-19 hit the U.S. ran out on Labor Day weekend. As a result, many unemployed people who had previously been getting payments in excess of what they could have earned while working are no longer able to do so. We think this should translate into a major surge in the job growth in September or October, and think there is enormous upside potential for the next two job reports. No one should be surprised if one of these reports shows as much as 2 million new jobs. Seriously. Keep in mind that not all these jobs have to be real creation. Much of it would be workers who were being paid under the table to preserve their unusually high jobless benefits, moving back towards regular on-the-books employment. So, we'll see. Brian, Mr. Westbury seems to think that, now that those federal benefits have ceased, that we should see an explosion or at least a large surge in the employment market. So, hey, he's a pretty smart guy. He's usually right most of the time. So we will see. All right. I normally don't share stuff from John Malden. He's probably one of my favorite economists. He's someone I actually pay to read his stuff. This is his newsletter that goes out every Saturday, and usually read it on Monday mornings. And there's a couple things in here I do want to talk about. And what he's talking about in here, and I'll attach it to the show notes so you can read through this. But he's talking about the Buffett indicator. And, it's a ratio of stock market capitalization to GDP. And, looking here at, this chart, we can see right now, this yellow line is the Buffett indicator, and currently is at its highest, highest rating, going back years and years and years. So, what that tells us is that based upon this metric, it would tell us that the stock market is very, very expensive, based on its relationship to GDP right now. So again, the market appears to be overpriced, extremely hot right now. So, when it does pull back, it might be quite sharp. So I'm just trying to educate as many people as possible that, what to expect. I try to navigate this as best as I can, but, sometimes you get kicked in the nuts and, because you can't plan for everything. All right. This is an article from the Wall Street Journal I saw over the weekend. It's Biden expresses support for annual taxes on billionaires' unrealized gains. And I'm not going to read through all of this. There's a way to read this without, I'll send the link so you can read the whole thing without having to be a subscriber. But essentially what this article, breaks down is that, let's say you own AT&T stock. It usually trades around $30 a share. So let's say you have, on January 1st, that stock was, say, $30. And then on December 31st, that stock is now worth $33. So it's gone up 10%. So what this proposed legislation would do is that, you would have to pay gains on unrealized profits. So, because you don't realize a gain on a stock until, let's say you bought it at 30 and you sell it at 33, you got a $3 gain on your share. But in this case, you haven't actually sold the stock. You're just sitting on it. Let's say you're taking, AT&T pays dividends. So you're taking the dividends from AT&T. But it's say at the end of the year that you have unrealized gains of, let's just say 10% across your portfolio. So now you have to go and, pay taxes on that. That's what they're proposing. To me, you can't, it's inappropriate to tax someone on something that they haven't already or haven't sold. So now you're expecting people to sell off other assets to cover gains that they haven't even realized at this point. So, and if you think that this is only going to be for the billionaires or the ultra rich, I got nothing coming. I mean, it's, the income tax, when it was proposed back in, what was it, 1916 or 17, whenever it came into being, it only affected the top 0.1% of earners making over a very high number. But we know today it affects everybody. Pretty much if you're making over like $40,000 or $50,000, you're contributing to the tax base. Maybe not a whole lot, but you are being robbed to do that. So, I think this is a terrible idea. I don't know if it's going to go anywhere, but we'll see. All right. I do have one last thing that I did want to share. I know I've gone 18 minutes already, but this is from Tom Woods. His guest was David Stockman, and he's talking about the enormous amount of debt and the poor actions of the Federal Reserve over the last couple decades. So we're going to go ahead and I'm going to flip over to YouTube because I can play it faster. And we're going to start around the 5-minute mark. And, Mr. Stockman's going to go through, some of his solutions that he believes would actually, if we actually wanted to save this, the Titanic, as we're playing bumper boats with icebergs, and we're wondering why the ship's taking on water. It's like, well, you're crashing into all these things. And, just the general public is, dancing to the violinists, playing on the main deck. So it's like, get in the lifeboats, people, pay attention. So, all right, let's go ahead and give this a listen.
Yes, right. So let's start indeed with the Fed. Now, I don't know, again, how much could be done through executive order, or, I mean, obviously the Fed was created by an act of Congress, so I don't know if there has to be some congressional, I mean, that almost doesn't even matter. I just want to know what you would want to do. Okay. But what do you have in mind for reforming the Fed and whether it can be reformed? Because the problem is that the Fed started off with a fairly modest, if you might call, mandate, and now it has this ridiculous economic planning mandate. How would you ever keep it in a box, even if you did reform it?
Well, that's a good question, but I would actually go back to Carter Glass's idea of a banker's bank at the Fed, 12 regional reserve banks with a very limited role. And of course, we're a democracy, so if you got the thing straightened out, somebody could probably screw it up down the road a few decades, but you need to lay out what to do. So here's what's under my heading of root and branch reform of the Fed. One, repeal Humphrey Hawkins and all the legislative mandates, because those have to do with Keynesian macro management, and the central bank shouldn't be in that business. Number two, make it illegal for the Fed to actually own government debt or agency debt, because the Fed should not be in the business of monetizing the public debt. Number three, abolish the FOMC, the Open Market Committee, and get the Fed out of the price targeting, interest rate targeting, which is just the price of money, and debt targeting and stock market coddling and supporting. Get them out of the business of interfering in the pricing process of the financial markets and the falsification of prices for debt, equity, and other securities. Because after all, that's why they intervene so heavily. They think the market's wrong and they know what the right interest rate is, and the right yield curve spread, over the maturity spectrum, and what the stock index level ought to be or not be. Get them out of that entirely. And four, return to, as I started here, Carter Glass. He was the author, House Banking Committee author of the Fed Act in 1913. And his notion was the Fed is a banker's bank. It does nothing but passively supply funding through the discount window. That's huge. You got to go back to the discount window only, not this, constant daily, multi-billion-dollar intervention in the every aspect of the financial markets. Discount window only. Discount window would basically make cash available to banks in the system when they presented good commercial collateral, basically receivables for goods already made and shipped. So therefore, any expansion of the money supply, this was called the real bills doctrine back in the old days, and that's what Carter Glass actually believed in, and that was the founding principle of the Fed actually in 1913. Get back to the real bills doctrine that said, unless there's production that has already happened and goods that are already produced and on the shelf and waiting to be paid for, that's the only decent collateral to put behind any new credits created by the Fed. That ties the Fed's action to real developments in the Main Street economy. In other words, entrepreneurs and businesses and workers produce output, and that output then becomes the standard for any money creation in the system. And of course, if you do come to the discount window, which frankly was the Fed's tool, as some students of this know, for decades and decades, the discount rate was important, the discount window was important. And in modern times, it's Keynesian jerks that took it over, beginning with Bernanke, but frankly, I blame Greenspan in part, started this whole idea that there's a stigma attached to going to the discount window, that customers of the bank might get worried. The bank goes to the discount window. Well, hell yes, they should get worried. When the bank goes to the discount window, it's because they've overloaned, they've gotten to the edge of liquidity, they're not doing their business properly. And so, they should, one, have to go to the discount window, two, be exposed, and three, pay a penalty spread. I'm saying the word here very carefully, spread, above whatever the open market interest rate is. It's not the Fed targeting, the overnight rate, which is like 15 basis points today. The rate should be what the market sets, and anybody that wants to go to the discount window pays that rate plus, say, 100 basis points or 200 basis points, and that would discipline the banking system like nothing that you can imagine at the present time.
All right. We'll go ahead and end that there. Mr. Stockman is a very, very bright man, and I always enjoy when he's a guest on podcasts that I listen to. So there is one other podcast I am going to link in the notes. It's Congressman Thomas Massie on Tom Wood's show. It's episode 1969. I would normally play, a couple bits of this, but it got removed from off of Mr. Woods' page on YouTube. So evidently, I listened to it over the weekend. Yeah, I didn't hear anything in there that was misinformation or anything. I think they just talked about facts that, the social media doesn't prefer. So I'll attach that also. So I would highly recommend listening to it. It's definitely a good listen. And what I'll, like I said, I'll attach that to the notes also. So if anybody needs anything from me this week, feel free to reach out, shoot me an email, give me a phone call. Be sure to like, subscribe, and share with friends and family. And I'll be back, I'll definitely be back on Friday with the weekly wrap up, and I might have a few other things throughout the week. So have a great week, and I'll definitely, keep your eyes open for more videos. Bye-bye.